Imagine this. The Fed starts cutting rates to save the economy and accidentally lights the biggest AI bubble we've ever seen. Your mortgage gets cheaper, Nvidia rips, random AI coins 10x, and then regulators slam on the brakes. That's the path we're walking toward. And most investors are not ready for it. I'm Thomas Paul, this is the comment section, and today we're talking about why rate cuts are coming fast, what that actually means for inflation, for AI stocks, and for your portfolio over the next decade. Here's the setup. Inflation has cooled on paper. Headline numbers are drifting down, helped a lot by cheaper gasoline and energy. The story you're being sold is, inflation is under control, growth is slowing, now it's safe for the Fed to cut. That narrative matters, because central banks don't react to your grocery bill. They react to the story they can defend at a press conference. Here's where things get interesting. Those numbers hide something. Even if the inflation rate drops, prices are still way higher than 3 years ago. 0% new inflation does not mean the pain goes away. It just means the bleeding slows. But politically, once the official number looks tame, pressure builds to cut, no matter how stretched households actually feel. Now connect that to markets. For 2 years, high rates have been like gravity. They crushed hype, killed weak companies, and made boring bonds suddenly attractive. If we move into a cutting cycle, that gravity weakens. Risk assets breathe again. Growth stocks, long-duration tech, especially AI infrastructure names, tend to benefit when money gets cheaper and future cash flows are discounted less harshly. But it's even getting worse because this time, it's not just tech in general. It's AI at the center of everything. The biggest companies in the world are in an arms race. Data centers, GPUs, energy, talent. Lower rates make it easier to justify building trillion-dollar AI empires, even if the profits are still coming later. And when that story combines with "the Fed is our friend again," the danger isn't just volatility, it's mispricing, people paying any price for any AI narrative. Let's pull out the key lessons from this coming shift. First, understand the game. The Fed will cut based on narrative, not your reality. If unemployment ticks up, if growth slows, and if inflation prints stay near target, the public line will be, "We're achieving a soft landing." That gives them cover to pivot from higher for longer to carefully lowering rates. And here's where things take a step further. Markets move before the Fed actually acts. Bond traders front-run rate cuts. Equity markets sniff out the pivot months in advance. So if you wait for the official press conference saying, "We are starting an easing cycle," you're not early. You're the last one to the party, cleaning up the confetti. Second, cuts are not magic. Historically, the first rate cut often happens when something is already breaking. Credit stress, slowing earnings, a labor market that quietly rolled over. Stocks can rally on the hope, then tank when recession data shows up, then rally again when people see the bottom. It's messy. But then, the unbelievable thing happened. Every AI bull case you're hearing right now assumes smooth sailing, clean growth, no major credit events, and endless demand for compute. In reality, if credit markets seize up or profits disappoint, even the AI darlings can get cut in half on the way to changing the world. Third, there's a huge difference between the AI picks and shovels and the AI lottery tickets. Data center REITs, chip makers, power utilities, and networking companies are tied to physical build-out. Their demand is anchored in actual spending by big players. AI meme tokens, tiny unprofitable AI software platforms with no moat, and random website wrappers around open-source models. Those live or die on low rates and hot storytelling. But then he said this unbelievable thing. So, what do you actually do with all of this? This is where my own bias kicks in. In my early 30s, everyone around me was chasing whatever was hot. Crypto, story stocks, can't lose trades. I ended up putting real money into something boring, cash flowing, and frankly embarrassing to talk about at parties. It didn't moon, but it worked, slowly. That experience is why I side-eye every "this time is different" rate cut AI supercycle pitch. If cuts are coming, I'm thinking in tiers. Top tier, productive cash-flowing assets that benefit from lower rates, but don't require them to survive. That's your profitable AI-adjacent companies, diversified funds, some quality real estate, And yes, just holding short-term cash instruments while you wait for better entries. Mid-tier. Higher beta growth and AI names where you accept more volatility but still demand a path to real earnings. Not just user growth, not just engagement, but actual money. Bottom tier, pure speculation. Meme coins, zero revenue AI startups, anything where the bull case is mostly vibes. With cheaper money, this stuff will run. It will also wreck people when the music stops. Here's where things get interesting. Now, while we're talking about navigating complex cycles without losing your mind, quick note. This entire video, research, scripting, and production is run through fludge.io, the same system that powers this channel. If you're watching this thinking, I'd love a YouTube channel in finance or AI, but I'm not getting on camera, this is literally built for that. Fludge finds topics, writes scripts, designs thumbnails, pairs them with AI avatars, and uploads for you. You stay in control at every step. Edit the script, change the angle, even record your own video if you want. Over time, it learns what works for your audience. This is not low-effort spam. If it were, you wouldn't still be listening to me. If you want to build a channel like this without burning out, check out fludge.io. Back to what to watch from here. Watch inflation components, not just the headline. If energy and goods are cooling but services and wages stay sticky, the Fed will talk tough even as markets price in cuts. That tension creates volatility, which is where patient investors quietly build positions instead of panic buying green candles. Watch credit spreads. When the gap between safe bonds and risky bonds widens, that's the market telling you, we don't fully believe the soft landing story. If spreads blow out while the Fed talks about cuts, that's not bullish. That's fear. But it's even getting worse because layered over all of this is politics and regulation. AI is now a national security issue. That means sudden rule changes, antitrust fights, export controls on chips, and investigations into data practices. Lower rates can juice AI valuations, while regulators simultaneously try to cap AI power. That friction can crush specific names even as the index looks healthy. So my verdict looks like this. Yes, rate cuts are probably coming faster than most people expect, driven by the need to support growth and manage debt costs. Yes, that is generally good for long-duration assets like tech and AI. But no, that does not mean you blindly chase the loudest AI ticker on social media. Instead, separate story from structure. Favor companies with real cash flow, real moats, and real demand tied to the AI build-out. Use any panic around recession headlines as a chance to upgrade your portfolio, not to dump quality for whatever is pumping that day. And here's where things take a step further. If you're a long-term investor, your biggest edge is not predicting the exact date of the first rate cut. It's having a simple playbook before it happens. Decide now, what do you buy more of if markets drop 20% on a hard landing scare? What do you trim if your favorite AI name doubles purely on hype? What cash buffer lets you sleep at night so you don't sell the bottom? I'm not your financial advisor. This is for education and entertainment only. Talk to a licensed professional before making big moves. And remember, unless something is insured, you can lose money. Quickly, let's wrap this up. Rate cuts are not a cheat code. They're a shift in the rules of the game. AI, big tech, and regulators are going to fight over who controls the upside of that shift. Your job is to not be the exit liquidity. So here's my challenge to you. In the comments, tell me one thing you're planning to do differently in your portfolio if the Fed cuts twice in the next 12 months. More AI? Less AI? More cash? I want to see how you're thinking about it. If you found this helpful, hit subscribe, turn on notifications, and join me next time on the comment section with Thomas Paul, where we keep poking holes in the narratives you're supposed to just accept.